Welcome to Investors Guide. You're watching ET Now. I'm Faye D'Souza. Thank you so much for tuning in. We have a wonderful show lined up for you this week. Lots of advice that you can use and you can apply to your own portfolio. Starting up, 31-year-old woman from the armed forces. We help her manage her finances and plan out her future. In our product review, we look at the HDFC Top 200 fund, a big fund with a lot of interest. We'll find out if you should stay invested, and we'll tell an NRI if he needs to pay capital gains tax after exiting his Indian mutual fund investments. All right, it's time for me to bring in Narendra Kumar, the CEO of Value Research. Narendra, thank you so much for joining us on Investors Guide. It's been a very interesting week at the markets, but on this show, we keep our focus on our long-term portfolios, which brings us to our first question, and we have a woman investor who's written in. Well, Vijay Saha has written in, Narendra, from Sikandrabad. She's a 31-year-old armed forces officer, and she hopes to retire with a corpus of 5 crore rupees. It's very interesting. She's written in saying she'd like to work for 10 years after she retires. She's hoping to work until the age of 70, but she'd like to have 5 crore rupees in her bank account at the time over the next 30 years. Now, she'd like to have a corpus of 2 crore rupees for her child's education over the next 25 years as well. But she has an income of 9.4 lakh rupees that's coming in. Obviously, insurance taken care of by the Army and the Defence Service Officers Provident Fund. She's also investing in the NPS, and she has an EMI of about 31,000 rupees going in every month. Narendra, before we get into the specifics of her mutual fund investments, she's putting 30,000 rupees per month into a set of mutual funds. Is that allocation enough to achieve her goals if you look at her portfolio as a whole right now?
Yes, I think it's just a matter of how much can you invest for the long term, and all that money which you can save should be finding its way into mutual fund. And given her goals, I think they will be reasonably met even with her mandatory savings. But 30,000 rupees to be invested in mutual fund, assuming it gives 1.5 times or twice as much as the risk-free rate, it will accumulate to something like 10 crore. And if it is to be increased annually with your rising income, then it could be much more. Over and above your mandatory savings into the Army Group Insurance Fund or the Provident Fund, that will all add up to create larger cushion. But the whole approach should be to keep it simple. Have a portfolio of 3-4 funds, invest regularly, keep increasing your allocation or investments with your rising income, and don't get distracted. Don't diversify beyond a point.
Let's take a look at the fund she's using, Narendra. She has 3 mutual funds that she'd like to invest in: the DSP BlackRock Microcap, iPru Balanced Advantage, and ICICI Prudential Value Discovery Fund. Might not be the best combination put together. Would you rather have her use one of our ready-made portfolios on Investors Guide?
A portfolio for the long term should be built with something which is low maintenance. So either it is built conservatively, she can pick from our stable growth portfolio, which is made up of 4 balanced funds, including the one she has, or our growth portfolio. Our growth portfolio will has potential to be more rewarding over this time period, and definitely for 25 years time period, investing regularly in a set of funds which are better diversified, one should not get distracted by relatively superior return of a certain narrow set of funds with a narrow focus, something like micro cap or things like that. That could be quite that's quite a distraction which many investors face.
Narendra, she has one last question, which is there is the mutual fund corpus, obviously, that she's putting money into, and there's the Defence Officers Provident Fund account that she's putting money into as well. She'd like to pay off her home loan over the next 7 years or so. She's made a plan of how she's going to withdraw money from both her mutual funds and her Provident Fund to pay off that loan. Now, ideally, if she'd like her to achieve her goal, she should keep that mutual fund money invested. How would you like her to pay off the loan if she wants to? Where should she access that cash from?
No, the simple principle to be followed here is, if you have made up your mind to repay your loan, then you should be repaying loan from your fixed income, because the interest, the cost that you incur on your home loan will be more than what your Provident Fund will earn. So I would say that your equity funds, which is a long-term investment and can potentially be more rewarding and will have its own ups and downs. So that should be untouched, and periodically withdraw your money from Provident Fund to repay this.
Vijay, quick words of advice for you. Do not pull out money from your mutual fund corpus. Pull out money from your Provident Fund corpus. If you put aside 30,000 rupees every month for the next 25 years like you've planned, you will have 10 crore rupees or might be more than that over the next 25 years. So you seem to be on track. And of course, for the home loan that you're talking about, if it's under construction right now, once you get possession of that home, you can claim the interest that you've paid on the home loan. And of course, if you lease it out or you rent it out, then according to the tax benefits, you get the principal that you can claim as a tax benefit, and the interest component is unlimited that you can claim as a tax benefit. Right back to us if you need any more help at all. It'll be our pleasure to help you. Then the one very quick question. Shivakumar has written in from Hubli. He's 50 years old. He's been working in a private organization and he has no pension benefits at all after retirement. He wishes to build a corpus of 40 or 50 lakhs in the next 12 or 15 years. He plans to invest 5,000 rupees each in SIPs. He's picked HDFC equity. He wants a couple of other recommendations from you to help him achieve his target. It's a steep target, Narendra. What funds would you like him to use if he does have 10 years on hand right now?
10 years on hand, but if I would approach it very differently from his point of view. If he has never invested in market, then getting started with one or two funds from our stable growth portfolio will be a more desirable way. And else, if he has ever experienced and has reconciled to the ups and downs of the market, then might as well consider our growth portfolio.
Right, so our growth portfolio is on your screen right now, and someone from our team will send you a copy as well. There's also our stable growth portfolio. This is a set of balanced funds, so it might be a more steady way for you to get your feet wet when entering the equity market. If you'd like us to answer your questions, remember our email ID is at the bottom of your screen. But before we go into break, it's time for our beginner's guide segment. Now remember, we started off by telling you how you can get your KYC done, how to buy a mutual fund and open a demat account. Today we're going to talk about how to start an SIP into an exchange-traded fund or an ETF that you can do online. My colleague Krishna Kumar is standing by to guide us through the process. Krishna.
Thank you, Faye. This week it's all about investing in exchange-traded funds or ETFs through a systematic investment plan or SIP. Now, a prerequisite for you to do that is to have an investment account or trading account with a registered brokerage or financial institution. And after that, it's rather simple. First up, go to your service provider's website and log on to your trading account. Once you log on to your investment account, choose the tab which says SIP, and in this particular case it's called DIY SIP or Do-It-Yourself SIP. And first thing you do is that you create a SIP basket. An SIP basket is basically like a folder for your SIP investments to be put in one place. So give it a basket name, and there are 4 parameters after that you need to choose. First up is the SIP type. Now the SIP can be on the basis of the amount of money that you want to invest systematically on a regular basis, or the quantity of investments that you would like to purchase on a regular basis. So in this case, I'm choosing an amount. And after that, choose the frequency with which you want to invest. It can be monthly, fortnightly, weekly, or even daily. Once you're done choosing the frequency, punch in a start date for your SIP, which is usually tomorrow's date, and the total duration of your investment. Remember, systematic investment plans require that you're invested for at least 24 months or 2 years. And after that, all you have to do is type in the name of the exchange traded fund or ETF that you want to have an SIP in, and type in the amount that you would like to invest in it on a regular basis, and then of course, place the order. These are days when you can do it all by yourself online. But when it comes to investing in an exchange-traded fund or ETF, make sure you get all the professional advice you need before choosing one. And with that, it's back to you, Faye, in the studio.
Welcome back. You're watching Investor's Guide in ET now. It's time for our product review. And this week, we're turning back to the biggest fund in the market, the HDFC Top 200 Fund. Avan is here to give us an introduction. Avan.
Thanks, Faye. We look at the HDFC Top 200 Fund this week. The HDFC Top 200 is not a new name for the viewers on this show. With over 13,500 crore rupees as assets under management, this fund generates a large amount of investor interest. With a return of 22% since its launch in September 1996, the fund stands on top of the long-term chart among the large-cap funds. Let's take a look at its performance graph over the last 5 years. Now, the blue line is the fund and the red line is the benchmark, the BSE 200. The fund's performance has been inconsistent over the last couple of years. While the fund outperformed its benchmark in the category in the year 2010, it hit a rough patch in the year 2013. The fund's bet on SBI that year hurt its performance, thereby generating a return of 4%. Despite making a strong comeback the following year with a return of 47%, the fund's performance has declined in the recent times. The trailing returns show that the fund has fared better than its benchmark and the category in the 3, 5, 7 and 10-year periods. The popularity of the fund is its ability to perform well over the long haul. You'll notice that the fund ignores short-term pains and places high-conviction bets, making it apt for long-term investors. Let's find out whether this fund should feature in your portfolio as well. With that, it's back to you, Faye.
All right, Avan, thank you for that introduction. Narendra, HDFC Top 200, I think on this show, generates more investor interest than any other fund we talk about. While it's had a great recovery from that slump period, which got a lot of investors worried, it's still at about 3 stars on value research. Would you recommend we stay invested in this fund? Has the last 1 year sort of firmed up your faith in the fund management of HDFC Top 200?
Yes, it was not as outstanding a performer in a long period of time. And if you look at, very recent past 5-6 months, it looks like a struggle again. But I would say that, this fund manager in this fund and few other funds which he manages has been proved right on all the big occasions when everybody else faltered. This fund manager does well, and that may not be an annual performance, that may not be 2 years or 3 years, but and he does that by avoiding some part of the market which is otherwise very concerned about or not very upbeat about. And in 2-3 years' time, all the disappointment disappears, and the fund recovers or stacks up well. So I would say that despite its slipping rating, because our rating is a very methodical, quantitative approach to looking at risk and how volatile it has been. But I would say that investors should not give up. The same fund manager is managing it, who has proven his worth on many occasions. And in absolute terms, I don't think this fund is as disappointing as the relative performance looks like. So investors should stick to it.
All right, stick to this fund. Narendra, the risk grade on this fund on value research is still high. So if I'm an investor who's staying with HDFC Top 200, obviously the normal advice that we give on the show stands. I have to have a long-term horizon. I have to have the stomach for ups and downs. But what should I be prepared for? What sort of risk comes with the territory of investing in a fund like this one?
No, I don't think there's a big risk if you are having a 5-year and longer time frame to invest, and if you're investing regularly. In fact, the risk that is visible here in terms of relatively higher volatility compared to its peers, that might be to your advantage, because you'll be on many occasions you'll be buying cheaper.
All right, Narendra, finally, what's your star rating for the HDFC Top 200 fund on Investors Guide?
I would say that despite the struggles, it definitely and despite its 3-star rating on a risk-adjusted scale, I would slot it as a 4-star fund.
All right, a 4-star fund on Investors Guide, HDFC Top 200. Remember, Narendra said if you have a 5-year horizon, there's literally nothing to worry about when it comes to this fund. And if you're investing in any of the funds you hear about on the show and you have questions, you can reach us. We've been here for the last 6 years. We intend to continue to hold your hand. Narendra, let's move on to our hold or sell segment. 54-year-old Ramesh Kumar has written in. He sent us a list of his mutual funds. He's been investing since 2012. He plans to continue for the next 9 years until his retirement, and his hope is to create a corpus of 10 to 15 lakh rupees by then. He wants to know which of these funds he should invest in. Now, before we even get to the list, here's the thing that worries me. He has 3,500 rupees going into mutual funds every month. He has 4,000 rupees going into UTI unit-linked insurance plan in a quarterly format. I want to first look at that investment. Should he continue that investment, Narendra?
Yeah, it might sound a little biased on my part, but this is a ULIP which I don't dislike, in a sense that the insurance component of it, investors don't pay for it. it is actually a mutual fund, and you get the insurance for free. So in that sense, one should look at ULIP as a balanced fund, and you are getting insurance for free. But not to say that you should not take the insurance component of ULIP very seriously. Of course, it might be meaningful, but I think that in scheme of things for any investor who have dependents, they should look at insurance independently, and first get your term cover, get adequate insurance, and then you should think about investments.
If you're going to treat the UTI unit-linked insurance plan as a balanced fund simply on performance, then should he continue making that investment, or are there better options for him in the market?
Oh, there are better options, and it has not been a very disappointing fund, but it is there are definitely superior alternatives available.
All right. In fact, if you're wondering where those superior alternatives are, what I'm going to do is on our screen right now, I'm going to put up a list of balanced funds that Narendra has recommended. If you're making an investment for this year, it might form a decent alternative to the one you're making right now. Let's take a look at his investments, Narendra. ICICI Prudential Dynamic Plan, 1,000 rupees a month. This is a good performer, and he does seem to have a fairly longish-term horizon. Should he continue this investment?
Yes, it's the kind of fund which most investors should have as a mainstream part of their portfolio. It's the kind of fund which I keep referring as a diversified fund, low maintenance. This is the kind of fund which most investors should also have.
He also has Reliance Equity Opportunities. Narendra, same advice for this one as well? Continue the investment?
Yeah, likewise. Reliance Equity Opportunity is just as impressive and has a broad market exposure too.
Next on his list is the UTI MNC fund, Narendra. I know that this is going to cause a slight crease in your forehead. You don't really approve of thematic funds. Should he continue this investment? 500 rupees a month he's putting into it.
Yeah, generally I'm averse to anything which is thematic, because these funds tend to do very well in a certain kind of market. We don't have too many MNCs into the commodity sector or cyclicals. So keeping away from that, by design, these funds have done very well, and many investors are getting attracted to it. Given the small amount and reasonable diversification of this fund, one might carry on.
Next on his list is the SBI Blue Chip Fund, Narendra. Continue with this one as well?
Yes, SBI Blue Chip has emerged as a very impressive large cap fund of late. Yes, one should carry on.
He also has the UTI Income Opportunities Fund, Narendra. Considering he has a 9-year horizon, and I want to take you back to the first fund that you looked at, which is the unit-linked insurance from UTI, and you recommended he replace it with another balanced fund. Can he combine these two and just replace that allocation with one balanced fund? Would that make more sense?
Yes, absolutely. A 500 rupee SIP in an income opportunity fund just doesn't make sense.
All right, and just to make that clear, those balanced funds are going to be put back up on your screen right now. If you want to write down those names, someone will email a copy of it to you as well. If you'd like us to take a look at your portfolio, write to us. Our email ID is at the bottom of your screen. You can reach both Narendra and me on Twitter as well. Narendra, thank you so much for spending time with us this week. Welcome back. You're watching Investors Guide on ET Now. It's time to take a look at our taxes. Suresh Surana is here to help us answer those questions. Suresh, thank you for joining us. Our first question comes in from Rajneesh. He's an NRI based in Dubai. He tells us he holds a tax residency certificate. Now, he sold some units of a debt mutual fund, which he was holding in India, and he gained capital gains. And he wants to know whether he's going to have to pay capital gains tax in India. What should he do?
Yes, so Rajneesh, in your case, you are a resident of Dubai. You are holding a tax residency certificate, and India has signed a double taxation avoidance agreement with the UAE, of which Dubai is a part. So, as per Article 13 of the double tax avoidance agreement between India and UAE, only the shares of Indian company when you sell, those are subject to tax in India. The unit of a mutual fund are not shares, and therefore they would not be subject to tax in India, and this is a benefit which you can claim. Recently, one of the Mumbai tribunal decision has also upheld this view in the case of India-Swiss double taxation avoidance agreement. So, you can certainly claim that it will not be subject to tax in India.
You have another question from Paul D'Souza, who's written in. Now, he says there's a lot of news on the Black Money Act recently. He wants to know what provisions it has on domestic transactions and other cash purchases. Suresh?
Yes, Mr. Paul, indeed, the new Black Money Act has already become operative. It was passed by both the houses of parliament, and the president gave approval on the 26th of May, and it has also been published in the official gazette on 27th of May 2015. This is already operative from 1st April 2015 onwards. But contrary to the name of the act and the popular belief that this is not covering black money in all the aspects, it is only covering the foreign assets and foreign income. So if you have any domestic transaction which is not fully reported, either in the form of whatever, that is not covered by this new law. But having said that, the existing law, there are enough provisions, like under the Income Tax Act, there is a tax of 30% plus surcharge and cess on such income, and also there is a penalty up to 3 times of the tax involved, even under the present law. So this while the new law is not applicable to you, but under existing law there are enough penal provisions, except that this will not be covered by the Prevention of Money Laundering Act, and the rigorous imprisonment provisions which are there in the new law, which are far more severe, will not be applicable to domestic black money transactions.
Faisal writes in, he's an NRI as well, this time from Singapore. He says a few years ago there was a proposal in the income tax law where it was proposed that NRIs will lose their non-residential status if they stay in India for more than 60 days in a year. He wants to know if that proposal has been implemented. If I'm not mistaken, Suresh, that was part of the DTC or the Direct Tax Code. So that hasn't been implemented yet, has it?
Yes, I mean, this was a very major concern for a lot of non-resident Indians who are living in different parts of the world like US, UK, Singapore, UAE. And at present, as you know, NRIs can stay up to 181 days in a financial year and still be a non-resident for tax purposes. There was a proposal in the Direct Tax Code bill in 2010 that this period will be reduced to 60 days only, and if the person is in India for more than 60 days in the financial year and more than 365 days in the previous 4 financial year put together, he will be treated as a tax resident of India. But the Direct Taxes Code bill never was passed, and the new government has already announced that they do not want they do not intend to implement the Direct Tax Code. So the law continues as it was, and therefore you can stay in India up to 181 days without losing your tax status.
Well, unfortunately, that brings us to the end of this episode of Investor's Guide. If you have any questions at all, write to us. Our email ID is at the bottom of your screen. So is my Twitter handle. And of course, you'll find a copy of this show on our Facebook page. Suresh, thank you so much for answering our questions this week.
So, thank you very much.
Tune in next week and catch Investor's Guide. Thanks for watching.